minutes.
And we should point out here, I mean, normally these minutes tend to come in one batch of headlines, but of course, over the last couple of years, they've actually sort of trickled out. So we basically have to read through this statement right now. I do believe we have the text, and we're going to break it down as soon as we get the information.
Yeah, they're sort of at the moment, if you go to the T-Live blog on Bloomberg, they are saying the median survey projection for the commencement of the balance sheet runoff shifted into the third quarter of this year, roughly a year and a half sooner than in the December surveys.
And they're saying that a significant balance sheet cut is likely appropriate. Again, doesn't exactly say the timing, but a balance sheet cut, and I think that's what everyone's anticipating here, Taylor, that we are going to finally move not only away from QE, but to actual QT.
We're going to dig into all of this, of course, with our own Mike McKee. We also want to bring in Chris Brightman, CEO and CIO of Research Affiliates. $169 billion in assets under management, bringing over 40 years of investment expertise, not to age you, Chris, but let's talk a little bit about the significant balance sheet cut that is likely appropriate. Are you more worried about the size of the hike coming or what is done with the balance sheet and when?
I'm much more worried about the inability of the Fed to raise interest rates to the level that's going to be necessary to get inflation under control, given the likely yield curve inversion and slowing in economic activity that will result from the tightening even before inflation is under control.
Well, that's what a lot of people are kind of interested in right now, Chris, is that whether you do 25 points or 50 basis points, that some of the damage that we've already had right now from inflation, it's basically there, and 50 basis points isn't necessarily going to roll that back. Do you see a threshold where monetary policy can throw that back?
Well, Romain, you really hit the nail on the head. Look, we're running at 7.5% inflation. The market pricing in the bond market suggests that the Fed is going to be able to tighten by, call it 6 25 basis point moves. If we're starting pretty close to zero, we're talking about getting to a 1.5% Fed funds rate. It defies logic how you take nominal interest rates to 1.5% when you're running 7.5% inflation, and that's going to cure the inflation problem. And there's going to be no more tightening necessary. The idea that the Fed fund, that the 10-year is just going to sit at 2% while inflation continues to run, I think, I understand the market doesn't want to fight the Fed, and the dot plots inform the market pricing, but it's an awfully optimistic scenario.
All right, we're in conversation right now with Chris Brightman over at Research Affiliates. We want to bring our Bloomberg International Economics correspondent, Michael McKee, into this conversation, who has a little bit more information about what's in the text of those Fed minutes. Mike.
Well, I've been reading it as fast as I can, Romain, and basically what the minutes confirm is what Wall Street already knows. There doesn't seem to be the same kind of new information that Wall Street took away from the minutes of the December meeting. But basically what they're saying is if inflation does not move down as they expect, and most of them did expect it to continue to move lower through the course of the year, then it would be appropriate for the committee to remove policy accommodation at a faster pace than they currently anticipate. Some participants commented on the risk financial conditions might tighten unduly in response to a rapid removal of policy accommodation. So some are worried that they could go too far too fast. And others said that a few said that this could be mitigated through clear and effective communication of the committee's assessment of the economic outlook. So the Fed is aware that they have an inflation problem and they are going to have to start raising rates. They felt it would be appropriate soon, but they weren't sure how far to go. They might have to go faster than they were thinking. In terms of the balance sheet, in terms of MBS sales, the mortgage sales, they thought that a number of them commented that sales of agency MBS or reinvesting some portion of principal payments into Treasury securities, switching how they're doing the reinvestment, might be appropriate at some point to enable suitable progress toward a longer run portfolio consisting only of Treasuries. So, and the first discussions we've seen of something of the possibility of sales, at least within the Fed.
Interesting. Faster pace than 2015 warranted. FOMC also seeing a faster tightening pace if inflation doesn't move down. Are these 25 basis point moves at every meeting? Is it intra-meeting? Does that spook the market? Is it front-loading, as some economists said, to get ahead of what could be slowing growth in the second half? What does that look like?
Well, it's hard to know at this point because we have, as you mentioned earlier, got these minutes from 3 weeks ago, and a lot has changed since then. When the minutes, just before the minutes came out, James Bullard had given an interview just before the meeting, rather, saying he didn't think they needed a 50 basis point move. Then last week, after we got CPI, he's all in favor of a 50 basis point move, and now we're watching everyone else's comments to see if they have changed their views as well. So I'm not sure how much this tells us, other than they were anticipating that if inflation did not go down, they would have to move faster than what they had said back in December. That's the problem for the Fed, is they make their forecasts once a quarter, and Wall Street makes a forecast every day.
Yeah, don't we just? Mike McKee, always wonderful to have him break down what is in the statement. Let's break down on what is the reaction in the market, because we're seeing the dollar, as you see, fall to new lows on the day, down 0.3%. Chris Brightman, back with us, CEO and CIO of Research Affiliates. Talk to us about, therefore, you were saying, look, the inflation number is clear and evident. It feels to you as though what the Federal Reserve needs to do. Where does one reallocate in this new kind of dimension?
Remember that the very lofty valuations for high-growing stocks, the darlings of the past, 10 years, has been supported, undergirded by extraordinarily low interest rates. When you're discounting far distant cash flows by negative real interest rates, you can justify very high stock prices. And so what we're seeing now is the beginning of the end of these extraordinarily low discount rates. And so it might be better to think about earnings yields instead of PE multiples. It's just the reciprocal. But many of these large tech stocks are sporting earnings yields of 1%, 2%, 3%, barely even the equity risk premium of long-term history. And that's why they're under threat. Note that the increase in interest rates so far has been almost all real. You know, taking the 10-year from 1.5 to 2 coincided with the 10-year TIPS yield going from -1 to -0.5. So this has all been an increase in real interest rates, which is, if you think of equities as real instruments, this is increasing the discount rate. That's why these tech stocks have been underperforming and why value has been outperforming. So in addition to rotating into traditional inflation hedges like TIPS and REITs and commodities, I also think it supports a continued rotation out of growth into value.
Chris, we just have about 30 seconds to a minute left. At what point on that 10-year yield are bonds attractive on that relative basis to equities?
Wow, that's a good question.
Stumped him.
I think, with nearly a 10-year duration, given where the very low level of interest rates, you've got a lot of risk in the 10-year treasury notes as well. If I had to pick a number, I would maybe say 2.5, 3.